All right, welcome. Today, we are pulling back the curtain on a seriously powerful financing tool. It's something that lets you scale your real estate portfolio based on a property's income potential, not what's on your personal paycheck. Let's get right into it.
For so many real estate investors, the answer here is a big, frustrating yes. You find a fantastic deal, you're ready to grow, but then you hit a wall with the traditional banks. They look at your personal debt to income, your W-2, and all of a sudden, financing your 10th property is way harder than your first, even if that new property is an absolute cash flowing machine. For years, the only real alternative was going the private or hard money route. And look, it got the job done, but it was usually expensive. We're talking rates over 10%, really short terms, and that dreaded balloon payment always looming, forcing you to refinance constantly. But things have changed. Now, there's a much more stable, long-term solution, and that is the DSCR loan. So here's our game plan for this explainer. We're going to start with that classic investor's dilemma. Then we'll introduce the DSCR loan as the solution. After that, we'll get into the nuts and bolts of how they actually work, look at a couple of real-world examples, and wrap up with some really important red flags every investor should know.
Okay, so what exactly is this solution that can unlock all that investment potential? Well, like I said, it's called the DSCR loan. And this right here is the aha moment. This is the game changer. A DSCR loan qualifies based on one simple, powerful question. Does the property itself generate enough rent to cover its own mortgage payment? Your job, your personal income, your employment situation, none of that is part of the equation. It's all about the property.
I love this quote because it just demystifies the whole thing, right? DSCR loans aren't some strange new invention from another planet. They're just taking proven, time-tested tools from the commercial real estate world and simplifying them for everyday residential investors. It's a brilliant bridge.
Okay, so let's pop the hood and look at the engine. Let's get into the mechanics and see how this all works on paper. We're going to break down the numbers and the rules so you can see just how straightforward this really is. It all comes down to this one term, debt service coverage ratio, or DSCR. And the calculation is super simple. You take the property's gross monthly rental income and you divide it by the total proposed mortgage payment. That payment is often called PIDIA. That's just principal, interest, taxes, insurance, and any HOA dues. The number you get from that division, that's your DSCR. So let's walk through it. Step 1, you figure out the rental income. Step 2, you calculate the full proposed housing payment, the PITI. And step 3, you just divide the income by the payment. If the ratio is exactly 1.0, that means the rent perfectly covers the mortgage. Anything above 1.0 means the property has positive cash flow. Simple as that.
And what's really cool is how this product has evolved. Back around 2017, lenders were pretty cautious. They wanted to see a 1.25 ratio, which means you need a 25% extra cash flow. They'd factor in all sorts of expenses and vacancies, and you pretty much had to be a seasoned pro. But guess what? The loans performed incredibly well. They passed every stress test thrown at them. So today, the product is so much more streamlined. A 1.0 ratio is often the benchmark. They don't hit you with arbitrary expense factors on long-term rentals. And get this, even first-time investors can qualify.
So how is that rental income actually figured out? Well, for a standard long-term rental, it's easy. The lender just uses whichever is lower, the actual signed lease you have in hand or the market rent from an appraiser's report. For short-term rentals, they use data projections from services like AirDNA. But, and this is just common sense, they apply a 20% expense factor to account for the higher costs of running a vacation rental. Cleaning, utilities, marketing, all that stuff. I mean, just look at this. This really sums up the power of this program. No verification of your personal job or income. You can hold the title in an LLC for protection. There's no limit on how many properties you can own. First-time investors are welcome. Some programs even let the ratio dip a little below 1, down to 0.75, and you can still get up to 80% loan-to-value. It is just incredibly flexible. Okay, enough theory. Let's see how these loans actually come together in the real world. We're going to look at a couple of recent deal examples that really show this in action. First up, we've got a classic investor move, buying a 3-unit property. Multi-unit buildings like this are just a perfect fit for a DSCR loan. So let's look at the math here. At an 80% loan-to-value, the market rents for the 3 units came in at $4,800 a month. The total mortgage payment was just over $3,300. You divide the rent by the payment, and you get a fantastic DSCR of 1.44. That's 44% more income than you need to cover the entire mortgage. I mean, that is a total slam dunk.
All right, now for something completely different. Let's take a look at a short-term vacation rental in a super high-demand market, like the Florida Keys.
So for this deal, also at 80% LTV, the total payment was $5,400 a month. But here, instead of a lease, the lender used projected revenue data from AirDNA to qualify the income. And even after applying that 20% expense factor we talked about, the property still generated a really solid 1.160 DSCR. This just shows you how flexible the program can be.
Now, getting the loan is one thing, but being a smart investor is the whole game. So in this last section, let's cover some important red flags and underwriting hurdles that you absolutely need to be aware of. This is about protecting your investment.
Okay, this is rule number 1. It is absolutely essential to remember these are business purpose loans for investment properties only. If you use the funds for personal consumer purpose, like, say, a down payment on your own home, that triggers a whole different set of federal regulations, known as TRID. You have to keep business and personal completely separate.
And here are a few other things that underwriters are going to look at really closely. If a property was just listed for sale and didn't sell, that raises questions about its true market value. Same thing if the value suddenly jumps way up without any major renovations to justify it. Unpermitted work is always a problem, and long vacancies can be a sign that a property is just really hard to rent. It's all about validating the property's real, sustainable income potential. You know, when it comes right down to it, it all boils down to these two simple questions. Number 1, is the property marketable? Meaning, is there real, consistent demand from tenants to rent it out? And 2, is it legal? Meaning, are all the additions permitted, and is the use compliant with local zoning? If you can say yes to both, you're on a great track.
So, there you have it, the investor's secret weapon, completely demystified. It's a tool designed specifically to help you scale your real estate business based on the quality of your deals, not the limits of your personal W-2. So the only question left is, now that you know the secret, how are you going to use it?